Finance, a man-made resource, but now so vital for us to reach our goals, be it business or personal life, be it an expansion program in a company or be it an educational program in a personal life. We need money. It's one of the very fundamental resources for us to reach our goals and dreams. Even though this is so fundamental in our life, we probably didn't get any formal education on it. Our academics focused on science, mathematics, history, geography. Not that they are irrelevant, but they are quite relevant. But the most important aspect which goes all through the lifeline is the aspect of money, and we have never been academically trained in that. With the result, most of us learn how to handle money, how to handle wealth, how to create wealth, or financial planning, all by a trial and error method. In this presentation, we'll be looking at 8 fundamental principles which are governing financial planning. By interchange, people use the word wealth management, financial planning quite frequently. I'm going to work on one word called financial planning, meaning at times it will also refer to wealth management concept as well. Now, there are 8 fundamental principles which we are going to look through. The first fundamental principle is that income minus expenses is equal to savings is a wrong approach in financial planning or wealth management. In fact, the correct approach will be income minus savings is equal to expenses. The people who adopt the formula income minus expenses is equal to savings seldom save money. Income minus savings is equal to expenses, the correct formula. If a person is earning 100,000, let him save that 20,000 first and spend the balance 80,000. In case it is little too much for him, let him donate to others, or even if it is surplus much more than that, throw it into Indian Ocean. But let the 20,000 be saved first. These 8 principles which you're going to look through may appear quite elementary, but believe me, they are the fundamentals of financial planning. Sometimes they are so simple that we try to ignore the concept because we normally believe success comes out of very complex formulas and complicated ideas. No, it's nature is not structured that way. It's very simple. So the number 1 principle in financial planning is income minus expenses equal to savings is a wrong approach. Income minus savings equal to expenses is the correct approach. The second aspect which we're going to look at as a fundamental principle in wealth management or financial planning is it is not in income management, but it is in outgo management that a person becomes wealthy. When we come across people explain financial planning to them, some of these people say, once my income goes up, all my problems will be solved. Maybe, but we must also understand these problems may get solved, but then we may get into another problem altogether, another set of problem altogether. Because basically it requires an attitudinal correction. Income going up does not solve our problems. It is in fact, if we are able to contain the outgo, that produces wealth. I'll give an example. Let's say a person is earning 100,000 but is spending around 150,000 every month. There's no chance that he can ever become wealthy. Now let's assume another person earning only 10,000 a month but is able to contain his outgo to 8,000 rupees. At some point of time in his life he will become wealthy. This is not a very modern concept as well. 17th century, Mr. Adam Smith, known as the father of economics, writes in his book, An Inquiry into the Nature and Causes of the Wealth of Nations, one of the very popular books in economics. I quote, "Capitals are increased by parsimony and diminished by prodigality and misconduct. Whenever a person saves from his revenue, he adds to his capital. Passive money, we are able to control our expenses. Having a control over expenses. Passive money does not mean being stingy or misery. Parsimony means being a calculated approach to expenses. Capitals are diminished by prodigality and misconduct. Throw away. Despair, show off, snobbishness. Know that they are things which really reduce the capital drastically. Like nowadays, you will find the entire media and manufacturing sector together, they try to motivate people to indulge themselves, to lead an extravagance of life. You look at most of the advertisements, it's talk about luxuries, it talks about extravaganza, it talks about indulging. That is not the way to generate wealth. In fact, you must increase your income even before you aspire for such things, such big things. Capitals are increased by parsimony and diminished by prodigality and misconduct. If you look at most of the companies on the business world, you will find they maintain budgets, there are revenue budgets, there are capital budgets. Whenever we are talking about growth rates, it talks about sales growth rates, income growth rates. But if you look at anything to do with expenses, you will find the finance department always coming down with the saying, we must cut this, we must cut this. Because one thing we know that wealthy, to become wealthy, income management is not the key. It is the outgo management which is the key. Much earlier to 17th century, 1st century, a Indian saint wrote, "Agaru alavittidayinum kedillai pogaru agala kadai." Translated into English, it means that even if the inflow is limited, that does not cause a crisis as long as we are able to maintain the outgo within that income, within that inflow. The third important principle which we want to address today in terms of financial planning is what is key to wealth. In fact, regularity is the key to wealth, not IRR, not ROI, return on investment, internal rate of returns. The key to wealth is regularity. A person who is able to even save regularly, let's take for example $1 a day. If he's going to keep it in his box or a piggy bank, it will become only $7,300. But if the same is invested at 10% interest, this $1 in 20 years becomes almost $23,000. If a person is able to regularly save 10 rupees per day at the rate of 10% yield, in 20 years it becomes 229,000. That's 230,000 approximately. A person who is able to save 100 rupee a day, just 3,000 a month, is able to produce a wealth of about 2.3 million in a period of 20 years. In many middle class, lower middle class families, when we ask them, why would you not like to send your children abroad for educations, to those institutions where they want really to get educated, they say, what to do, Mr. Gopinath? We are that fortunate, we are not so blessed. No, it's not a question of being fortunate or being blessed. It's a question of having saved that 3,000 rupees per month. A person who is able to save 1,000 a day ends up with almost 23 million rupees in 20 years period. Osceola McCarthy is an Afro-American woman who has become an epitome of this concept. Regularity is the key to wealth. She got employed at the age of 40 as a washerwoman, but she had a habit being a daily wager. After receiving the wages, before going home, she goes to the bank daily and starts depositing small monies, $10, like say. In almost about 30 years' time, 32 years' time, she gets a pink slip and she was asked to go home. The last day she goes to the bank with the $10, tells the clerk, son, look, this is my last $10. I've been coming here daily all these years, but not anymore. This is my last $10. I got a pink slip today. The clerk asks, ma'am, do you know how much money is in your account? She says, maybe $30,000, $40,000. No, Mrs. McCarthy, your account is showing a balance of $200,000. What is key to wealth? Regularity is the key to wealth. The clerk asked, ma'am, what shall I do with this money? Shall I encash it and give it to you? No, son, what will I do taking this so much money home? You do one thing, let the $100,000 remain in my bank account and transfer $100,000 to your bank's name and create a trust out of it so that students who want to enter universities but who do not have money to support their education, please help such people from this trust. Trust is created. Almost about 7-8 years later, she is suffering from pancreatic cancer, almost in her deathbed. Doctors say, ma'am, no need to treat you because you're almost towards the end. A maximum you'll live for another 2-3 days. You can go home if you wish to. One of the doctors says, Mrs. McCarthy, there's an oncologist in California. If we bring him down here to do surgery on you, you may get to live another 2-3 years. Not a guarantee, but chances are bright. Only thing, it's going to be prohibitively costly for you. She says, no problem, bring him down. Whatever I have in my account, I'll give him. The doctor comes, the surgery is done, operation successful. She's on her bed convalescing. The doctor comes around, asks Ms. McCarthy, how do you feel now? With folded hands, she thanks the doctor and says, son, for my sake, you flew all the way from California to get me operated, to operate on me. And I'm told now I may get another 2-3 years to live. But son, I don't know at this ripe age how am I going to repay you for that, for all that you've done to me. The doctor holds Mrs. McCarthy's hands fondly and says, what, Mrs. McCarthy, you talk about thanking me. Don't you remember me? I'm the first student who entered university using your trust money. If I become a doctor today, it's your money. I am thanking God that I got an opportunity to serve you while you are still there around. Regularity is the key to wealth. 3 principles we have seen till now. Income minus savings is equal to expense is the correct formula. Number 2, it's not in income management, but it is in outgo management. The secret of wealth management lies. Number 3, regularity is the key to wealth.